All right, welcome to this explainer. Today, we're cutting right through the market noise to build a definitive, evidence-based case file on an absolute behemoth, the Bank of China. Look, if you follow global banking, you already know this isn't just your run-of-the-mill bank. We're talking about a $4 trillion institution that serves as the flagship financial arm of the world's second-largest economy. It is literally a globally systemic institution. So what we're doing today is looking exclusively at the cold, hard data from their interim H1 2025 results to figure out exactly what is going on under the hood. Here is our analytical roadmap for today. First, the verifiable truth. Second, the macro landscape. Third, valuation and yield. Fourth, tactical recommendations. And finally, number 5, the ultimate red flag. Let's dive in. Section 1. The verifiable truth regarding financial health and asset quality. Okay, so if we treat Bank of China not as a high-flying growth stock, but as a financial fortress, we first need to look at profitability. In a volatile market, we need to know exactly how thick the walls of this fortress really are, right? Well, for the first half of 2025, they reported a net profit of 127.2 billion RMB. Now, at first glance, a 1.5% year-on-year increase might seem, well, incredibly anemic, especially if you're used to textile growth numbers. But honestly, context is everything here. For a bank with over $4 trillion in assets operating in a severely challenging, rate-cutting environment, this isn't a sign of weakness at all. It actually signals incredible stability. It tells us the engine is still moving forward, just in a lower gear. Now, what's really fascinating here is the non-performing loan ratio. It actually dropped by 3 basis points, down to 1.24%. Given all the broader headlines we see about Chinese real estate and economic sluggishness, you'd naturally expect bad loans to just be piling up. But instead, the data shows asset quality is surprisingly on the upside. They are keeping a remarkably tight leash on defaults. But, a declining non-performing loan ratio means absolutely nothing without a solid buffer to back it up. And they definitely have one. Their provision coverage ratio is sitting at a really aggressive 205.6%. So what does that actually mean for you as an investor? Put simply, for every single dollar of bad loans on their books, Bank of China has overinsured by setting aside $2.05 in reserve. They aren't just managing bad debt. They've built this massive margin of safety to absorb potential macroeconomic shocks without taking a direct hit to their equity. Bringing this first pillar together, their capital adequacy absolutely proves that the foundation is rock solid. With a common equity Tier 1 ratio at 12.38%, they are sitting very comfortably above China's 10.5% regulatory minimum. Look, if you're an investor who loses sleep over a surprise capital raise or a sudden rights issue that dilutes your shares, well, this data takes that risk completely off the table right now. Section 2. The macro landscape. Weighing the headwinds against the tailwinds. You really cannot analyze a Chinese state bank in a vacuum. They're deeply tethered to national monetary policy. So we're putting Bank of China on the weighing machine. On one side, we have the single biggest threat to their earnings, the People's Bank of China's rate cuts, which are severely squeezing their margins. But on the other side, we're weighing that directly against a historic leap into international fintech infrastructure, specifically their new digital RMB hub in London. It's a classic battle between domestic headwinds and international tailwinds. Let's zoom in on that domestic headwind first. The net interest margin compressed down to 1.44% in H1 2025. Basically, the PBOC has been cutting the loan prime rate to reflate the broader economy. That means the bank charges less for the loans it gives out, but it still has to pay its depositors. So the crucial takeaway here is that this margin squeeze is exactly why that profit growth is stuck at 1.5%. If the PBOC decides to cut rates again in Q4 2025, this squeeze only tightens. For growth-oriented investors, this dynamic acts as a massive red flag. However, flip the coin and we find a potential silver bullet that launched on September 1st, 2025. Bank of China became the very first Chinese bank to offer real-time e-CNY clearing for European corporate clients out of London. Why should you care about this? Because cross-border transaction fees carry margins 3 to 4 times higher than standard domestic loans. If this pilot expands further by 2026, projections show non-interest income could rise by 3 to 5%. This specific move is exactly what shifts Bank of China from being just a sluggish, pure lending play into a high-margin cross-border fintech powerhouse. Section 3. Valuation and yield. Let's look at the buy and hold numbers. Okay, we've looked at the fortress, and we've weighed the macro forces.
Now, let's get into the hard numbers that actually drive daily investment decisions. I want you to let this price-to-book ratio sink in for a second. 0.42. The broader market is currently valuing this massive institution at less than half of its net assets. Historically speaking, whenever a state-owned bank's price-to-book ratio drops below 0.40, it represents a point of extreme, almost irrational market fear. Trading at 0.42 means your downside risk from valuation compression is incredibly minimal. More importantly, if market sentiment just normalizes to a really conservative 0.50 ratio, you are looking at a potential 19% upside in capital appreciation alone.
But hey, you aren't just waiting around for capital appreciation. You are being paid heavily to wait. Based on the final 2024 payout of 0.258 RMB per share against an HKD 380 share price, you get a trailing dividend yield of roughly 7.4%. For pension funds, massive insurance conglomerates, or retirees seeking defensive core holdings, this incredibly high state-backed yield is basically as close to a bond proxy as you can possibly get in Asian equity markets right now. And the underlying safety of that 7.4% yield is really clear. Bank of China's dividend payout ratio is only 45% of their net profits. Compare that to the global bank standard, where many Western peers pay out 60 to 70%. Because Bank of China's ratio is so incredibly conservative, they can comfortably maintain their absolute dividend payout even if their net profits decline by 10% over the next 2 years. The cash flow is just heavily insulated. Section 4. Tactical Recommendations. Actionable intelligence based on your profile. So, given all this verifiable data, the stable fortress, the warring macro forces, and the extreme discount valuation, how should you actually position yourself? Here is our tactical verdict. If you're an income or defensive investor, the play is to accumulate on dips. Specifically, look to buy below HKD 3.70 to lock in a yield on cost above 7.5%. If you are a value or growth at a reasonable price investor, you should probably hold and wait. Don't add aggressively until we get a clear signal from the PBOC in Q4 that they are pausing rate cuts, because that will mean the margin squeeze has finally bottomed out. And if you're a short-term trader, well, the data suggests staying neutral to bearish. September and October are seasonally illiquid, so avoid chasing rallies and expect the stock to trade in a very tight 90-day range, somewhere between 3.65 and 3.90. Section 5. The ultimate red flag. What could go wrong? All right, we've established that Bank of China is fundamentally a story of stability, reliable yield, and state-backed survival. But as rigorous analysts, we have to flip over the final stone. You're probably sitting there wondering exactly what the catch is here. If the valuation is this incredibly cheap, the assets are provisioned at over 200%, and that 7.4% yield is safely covered, why isn't the market pricing this higher? Well, the catch lies entirely in how the bank is managing its own internal checkbook. Here is the red flag you absolutely need to circle in your notes: the cost-to-income ratio. In the first half of 2025, operating expenses rose by 6.2%, which actually outpaced their revenue growth. This surge is being driven by heavy, relentless spending on IT infrastructure, like that London hub we discussed earlier, and global compliance. If the upcoming Q3 report in late October shows this expense growth accelerating above 7%, it's going to start seriously eroding those net profits, applying immediate downward pressure on the stock price. So I'll leave you with this final thought. Keep a very close eye on those Q3 expense reports and the ongoing narrative around local government debts. Armed with all this data, you have to ask yourself, in a highly volatile global market where so many people are blindly chasing risky growth, is this heavily discounted, 7.4% yielding financial fortress exactly the defensive core holding your portfolio needs right now? Or is that margin squeeze just too heavy a burden to bear? Thank you so much for joining me on this explainer. And as always, keep following the data.